Hi traders, welcome to this edition of Expert Market Analysis brought to you by Errante. This is a bi-weekly review and preview, so every other week of the market's key events and trading opportunities. Whilst I just let you have a look at the disclaimers, there are a couple. We think markets are generally driven by themes which buyers and sellers relate to in order to enter and exit markets. These are stories or narratives that can be long-term, fundamentals or technicals, or short-term themes that increase or decrease in importance over time. This week, we will look at the current state of play in markets and this idea, this theme around a pivot by the Fed, by central banks. We'll briefly look into that, how plausible that is, and then look at some of the market internals actually, and then the technicals as we normally do on US stock markets, the S&P, the Nasdaq. And we'll look at the dollar, the DXY chart. We'll then review sterling and everything that's been happening in the UK. So we'll look at cables, that's sterling against the dollar, and also euro sterling. We'll then review actually the RBA meeting and the RBNZ meeting this week, some relevance to this idea of a pivot. And then we'll wrap up with a preview of non-farm payrolls. What's expected for the Friday data, the first Friday of the month, if you remember, always has non-farm payroll data, US unemployment, and that being a gauge for the Fed meeting in at the start of November. So a lot to cover. We'll straight away crack on actually with markets in general this year. First chart actually we thought was quite useful just to sort of show where we've come from. If you like, we put the summer denial. This is the US Fed funds rate, so the implied rate, which obviously we had that July summer denial, if you like. So the pivot there where markets expected were hoping that the Fed would not tighten as much. So you see that in July to August then, rate expectations falling. But then since sort of since August, we've then moved up higher. You can see some of the risk events here, the July FOMC, but certainly the July CPI meeting, the shock data there, and then Jackson Hole at the end of August, really, Fed Chair Powell showing the Fed's or trying to show the Fed's credibility in fighting inflation, fighting these rampant price pressures, and then Fed funds expectations for Fed rate hikes have gone higher, much higher. We actually hit 4.7% late last month, actually, so just above that 4.5% level. But then you see that we have pivoted only in the last few days, back below 4.5%. So this idea of the Fed pivots, really, that's a term which has even been trending on Twitter, actually, and that's the idea that the Fed will soon stop hiking rates and then soon afterwards start cutting them even. And we've seen this huge rally in risk assets. That's pushed the dollar sharply lower after hitting actually multi-decade highs only a week ago. And certainly positioning, we think, has been a big factor in the dollar in that swift fall from the top, with the market really severely overcrowded in long dollar positions. There's probably a few events which can sort of been reasoned for this pivot idea, which has really obviously kicked off markets into the final quarter of this year. We've obviously had central bank intervention in the last week or so. That comes in the form of currencies, of course, with the Bank of Japan intervening, the People's Bank of China as well, intervening in their currencies, trying to slow their depreciation against the dollar. And then we've had the Bank of England meddling, if you like, intervening in the UK government bond markets, really defining moments in some ways for the gilts market, that is. And this has all stabilized areas of concern, and kind of meant there's been less safe haven buying and then more risk taking as well. Secondly, we had that smaller than expected rate hike from the RBA. We'll touch on that later. And that's been flagged really as potential turning points for policymakers worldwide. Whether, of course, this is a permanent pivot or just a temporary slowdown is the key question for us. But it certainly buoyed hopes. Just for a few hours at least, buoyed hopes that other central banks would also taper off their rate hikes. And then finally, we've also had some focus on softer data coming out of the US. The JOLTS, job vacancy numbers, they've sort of never really been looked at until the last few months. And then certainly we've had these massive job vacancy numbers in the US. If you've been to the States at all recently, you can't fail really to notice so many signs, we're hiring signs. Well, that JOLTS job vacancy numbers, they fell very sharply last month, and way more than analysts actually predicted. And certainly it's been this tight US jobs market that has been a big factor in the Fed's aggressive policy tightening path. And that's simply because it puts upward pressure on wages and so inflation. Markets then kind of clinging on to those hopes, those three sort of reasons, if you like, that potentially the Fed changes course and it means they ease rate hikes going forward. That said, of course, we've had the RBNZ hiking as expected by 50 basis points. So potentially that refutes this discussion that certainly that slowdown, that slight slowdown in the RBA hiking is limited really to Australia itself. But volatility measures, they still generally remain quite elevated. VIX trading just below, that's Wall Street fear gauge, if you like. That's just below 30, and then a similar index for bond markets, that's still around 150 on the move, that is. So that's a volatility index for bond markets. So they remain elevated, and certainly if you think about what's been happening actually in the last few weeks, step back from just the last couple of days, but certainly we've had this sort of crisis management QE in the UK. We've still got an energy crisis as we go into the winter months in Europe and the UK as well, and we had sort of a systemic risk potential, again with that gilt market intervention being critical, and we've still of course got potential monetary tightening to come. Those have been some of the hottest sort of themes and topics, if you like, driving markets, and certainly over the medium term, they're still probably quite valid. And that certainly, if we just step back again, US stock markets have notched did notch their longest streak of quarterly losses actually since the market collapsed in 2008. If you step back into the third quarter, losses for the S&P actually from June to September 5.3%, and they were down, that index was down over 24% or so before the pullback yesterday, sort of still down in bear market territory over 21%, I think, for the year. The Nasdaq, the tech heavy index in the US, that reached its worst closing level actually since July 2020 to end the quarter last week, down 4.1% on the 3 months, and down still around 28% or so for the Nasdaq. I just pulled up the S&P chart here. But we can't forget then Fed speakers, and there will be many of those out this week as well. They're still re-emphasizing their hawkish bias and that the bank will stay the course on raising rates. Important to remember that, we think. There was actually one official that did say the Fed was conscious of market ructions, and this really goes back to the question we have been asking about how high the Fed will go before something breaks. in the system, if you like, or in the data. And that's probably key at the moment. The pivot is probably too early. Certainly, markets are sort of reining some of the moves back that we've seen in the last 48 hours. They're reining those in now, and we'll see from some of the Fed speakers whether they're still on the same hawkish page, if you like, which we think will probably be the case. Just for the market internals, we did mention that actually, in fact, just before we switch to the technicals, if you like, some of these market internals we think have been quite interesting up until sort of the end of last week. We've got here the S&P and its deviation from the 200-day moving average, and you can see we're down sort of 20%. We're 20% away from that that widely watched moving average, the 200-day, and you can see some of the sort of previous crises, if you like, and then when we've had recessions is that light grey line, and we're sort of 10% potentially has been a sort of 20% has potentially been a key area where markets have bounced, other than in these severe crisis mode periods, even where markets have sort of moved beyond, way beyond that 20% marker, beyond the 200-day moving average. Potential for a bounce then, I've just highlighted obviously the last quarter's really poor performance in stocks, in risk assets, but then we've just sort of pointed to this graphic that came up from Carlson Investment Research actually, but just pointing to when the S&P has been down sort of 8% or so and greater in September, then we have had bounces, and you can see a few occasions when that has happened over the last few decades, and we've had sort of bounces back in stocks in October. It's interesting, a lot of people think of October, think of sort of Black Monday, think of these awful periods for stock markets, but those are sort of a few occasions, and we need to step back and look sometimes at the wider picture. And certainly as we go into December, more often than not, I think seasonals point to a slight pickup in stocks. That's Santa rally sort of reasoning, given that sort of basic general reason given for the potential rally in stocks into year end. We pointed out actually Goldman Sachs, obviously widely watched US investment bank, they sort of cut their year-end forecast for the S&P down to 3,600, and you just see sort of a couple of different scenarios, actually a hard landing where potentially they see the S&P closing at 3,400, whereas a soft landing by the Fed, if they think that is happening, then the sort of year-end target is slightly higher at that 3,600 level, and you can see their year-end targets for next year, potentially 4,000 in a soft landing, whereas a hard landing still quite high, really 3,750, so just below sort of where we're trading currently, although the futures are actually trading at 3,756 today. So just something to bear in mind for some of you who follow some of the big investment banks and their forecasts. So technically, if we just have a look at the charts, we can see this is the S&P 500. The weekly chart, you can see actually, well, we should point out actually that bearish engulfing candle you can see there. And then that break of near-term trend line support actually, and then we had 3 weeks quite strong sell-off there, and prices hit this black line, so that's the 200-week moving average at 35.95, and then also obviously the mid-June low that we've been highlighting, 36.36. We moved down below there before this strong bounce obviously. I think last couple of days, the S&Ps enjoyed a bounce of 5.7% actually, and that's the biggest two-day rally since March 2020, since the pandemic actually. So a really big rally. Below here, we have actually highlighted the halfway point of the pandemic low up to the all-time high actually. That halfway point, the 50% marker, is at 3505. So something to bear in mind as support if we do possibly move lower through that 200-week moving average at 35.95. Otherwise, we have the next fib level at 38.15. That's the 38.2% level at 38.15. If we do move higher, and you can see on the daily then that 36.36 level, I've still got that trend line support, which is broken obviously, but before then we've got this 21-day moving average, sort of near-term initial resistance at 38.30, as well as that fib level, longer-term fib level we pointed out at 38.15. That's the S&P. Just if we look at the Nasdaq, similar type of chart really, but you can see again the mid-June support level, which we're actually hanging around. We haven't really broken conclusively. You can see for sure that's at on the Nasdaq 100. This is at 11,037. The 200-week moving average 11,203. We're just above that now, with futures trading at 11,500, just above there. And you can see on the daily then, what we've got in the long-term bear channel, if you like. We're sort of halfway in that now, and we've just sort of eased those overbought conditions as well. So you've got the 21-day moving average at 11,766. That's a sort of initial level of resistance, but potentially I probably should have drawn a bearish channel here for this move. We're sort of probably at the top of that channel, if you like. Yeah, moving towards the top of that channel, or at least the trend line resistance from that August high, which tallies really with that 21-day moving average around 11,766. Of course, allied to this sort of pivot move that we've seen is also then this move lower in the dollar. You can see, as I mentioned, last week's highs at 114.77. This is in the DXY. Remember, the DXY major weighting in this is euro, obviously around 56%, and then also sterling around 11%. So they've seen big moves, which we'll look at a bit later. But on the DXY, then the dollar index, we moved pretty sharply lower, but trading around the 21-day moving average at 110.88. We think there's major support then below this at the mid-July high at 109.29 as well to support then the 50-day moving average just below that 108.87. So potentially we hang around the 21-day and then we push up towards 112 on the DXY. Now we'll have a look briefly at sterling, everything in the UK, huge moves, huge movement in the gilt market, as we mentioned, but also obviously in sterling as well. The trigger point, of course, has been or was the government's fiscal event, that mini budget a few Fridays ago. Markets since really have been questioning the appropriateness of those vast tax cutting measures, really in light of spiraling inflation pressures, which were really only going to be made worse by those fiscal measures, and especially as well in the absence of an independent assessment of the medium-term implications for the UK's public finances. If we just step back, if you typically think looser fiscal policy and then tighter monetary policy, so the raising of rates whilst we get looser fiscal policy, is normally has historically been a positive mix for a currency. And that's the case certainly if you can be confident that these measures will be funded, the fiscal measures. But here, of course, is the issue, the nub of the issue and the rub, if you like. Investors have doubts over the UK's ability to fund these packages, these fiscal bumper packages, if you like, and foreign investors have then been shying away from UK debt due to the impact the plans will potentially have on the public finances. And really the markets last week at least quickly lost confidence in really in the UK's economic management. And one asset class we think is worth highlighting actually is obviously this impact in fixed income in the government bond market in the UK. There will still actually remain lots of questions around that. Just to put it into some sort of context, we're the daily moves actually in, well, 95% of the daily moves in the government bond market, in the 30-year market, just use that as an example, 95% of the daily moves are 10 basis points, so 0.1% plus or minus. But the 30-year move that we saw after that fiscal event, it moved 1.2% in 3 days. That was up, those yields, and then the yields moved sharply lower after the Bank of England intervention by 1.1% in 1 day. So really massive moves in the gilt market. And there are, as I say, still question marks around that. Obviously, the Bank of England intervened. They announced fresh gilt purchases of up to 65 billion actually, but they only have a limited time frame, and that is until October 14. So after that, we're not quite sure. It's not really clear what will happen after that date, and certainly actually why that end date was picked in particular. But certainly, yes, for now, the intervention has had an effect. The 30-year gilt yields, they've swung, as I said, over 1%, over 100 basis points lower following the announcement. But certainly, we also then had actually the Bank of England, if you take your mind back a couple of weeks, they had announced initially that they would be undertaking QT, so that's selling bonds, reducing liquidity a few weeks ago, but obviously then this QE process has mean they're buying bonds, and that sort of that has then been delayed, the QT actually to the end of October. So again, we have a lot of question marks around what the Bank of England will do after it really intervened in the gilt market and kind of averted a real crisis in that government bond market. Then this week, of course, if we just go back to Monday, we've had the U-turn, the abolition of the 45% income tax bracket in the UK. This really largely symbolic. It only represents or less than 5% of the measures, around 2 billion or so that's been saved. But of course, that look around government credibility, around policy making has taken a hit for sure. And there is obviously some focus around other tax cuts potentially being reversed as well, and that's obviously what markets have been focusing on this week. There's certainly been a backlash from the Prime Minister's own party, and then also we had that threat of a sovereign rating downgrade from the S&P. That shifted the outlook on the UK to negative from stable last Friday. The key issue then for the UK, we think, is still fiscal credibility, really. So the credible commitment by the government, by the Prime Minister and the Chancellor, the Finance Minister, around fiscal sustainability, if you like, and really markets still unconvinced, still thinking the finance minister, the chancellor, has a lot of work to do to convince markets that his plans are sustainable. Potentially, as I said, we may see more U-turns, possibly, and then we have the issues around cuts to public spending, if you like, those to do with social security, investment products, public services, and potentially then this runs up against issues in the Conservative Party itself in the UK, and whether then the Prime Minister has to rein in again some of the fiscal measures that it has promised. Certainly there's a lot of uncertainty then around the UK, but that said, of course, some of these U-turns are obviously positive for sterling and for UK assets, and we've seen that, of course, in cable, in sterling against the dollar, and technically then, just before actually we go to technicals, obviously going forward then we've still got these issues around sustainability, around what the Chancellor is hoping to do. We have the UK Prime Minister Truss's speech today. Normally wouldn't garner that much attention, but it's whether she sticks to her guns or reins in, as we say, some of those measures or hints at that. So that'll be important. That's the speech today, and then we do have some MPC speakers, some Bank of England speakers this week, and we'll be watching out for clues on how the MPC, how the Bank of England plan to respond to this fiscal expansion, basically, and their views potentially on this recent market volatility that we've seen. For cable, technically, then we can see that low. Actually, if we just have a look on the weekly again, you can see that that bearish engulfing candle, which was quite noticeable before then. Obviously, this serious sell-off, bearish engulfing candle, obviously pointing to lower prices, and we broke through the pandemic low 114.09. There wasn't much in the way of support down to 105, but obviously we spiked lower in Tokyo trading hours down to an all-time low, of course, of 103.56. We just pull back to the daily. We can see then this strong bounce back to levels actually seen just before Kwasi Kwarteng, the finance minister in the UK, delivered that mini budget, that fiscal event, and we were obviously pushed up with 6 straight days. These are this mini sort of bar chart here, just up days and down days. Green bars obviously up days. We've had 6 straight days of gains. We last saw that actually in April 2021. And certainly then this U-turns by the government, the recent events probably ease that risk, obviously, of trading cable trading back down to parity for sure. But it doesn't mean, of course, that we're out of the woods for sure. We kind of think potentially the Prime Minister, the Chancellor, is kind of showing a greater respect, if you like, to financial markets when considering their policy options. But technically then we're at a key juncture really now. 114.09 is the pandemic low, and we're trading just around there, just below there now. And then you've got that trend line resistance level from the August top actually, and we're just trading again around that level. So a key juncture really of resistance or support, depending which way we go. If we can break higher, then we've got the 50-day moving average, that light blue line, 116.58. But kind of this sort of long-term bear channel, even though we broke it out of it, you can see, and then that sharp bounce back, if you like. We're kind of still in that up to sort of 116.58 and above, really. So potentially, if we do roll over, then we've got that 21-day moving average near term, 112.92, before then potentially moving back down towards 110. Another sterling cross actually worth looking at is euro sterling. And you can see on the weekly, actually, if we pull back to the monthly, we've sort of looked at levels here where we haven't really held that much or for that long a time above sort of 91, 92, and even 90. You can see this is the monthly chart, remember, and any levels above sort of let's have a look, 92 really have been spikes, you can see, and we haven't held for very long. And even 91 as well. So that spike higher, 92.77. We saw the sterling weakness in those Tokyo hours, as we say, thin liquidity. But yeah, 92.77 was the high. And then if you just look at the fall down, we're now back to the mid-June high around 87.21 there, and you can see the 21-day moving average 87.58. So just to sort of bounce back towards that mid-June high at 87.21. Again, interesting point for euro sterling. Okay, let's just review actually the central bank meeting for the RBA for Australia. If you just bear with me 1 second while I check out the chart actually. Which is obviously Aussie dollar. But before that, we'll just look, just review what happened actually. The RBA, as I said, taken on a sort of slightly more importance than just a domestic feel for rates and for the Aussie dollar, of course, due to this pivot and potential move in other central banks. The RBA itself, well, they hiked only 25 basis points. Which certainly surprised markets on the dovish side. Consensus was looking for another 50 basis point hike, while actually the market was split. So market pricing in money markets in swaps was actually split between a 25 basis point move and a 50 basis point move. But analysts thought they'd go 50. So the 25 hike, in some ways, kind of not surprising. The RBA meets more than other developed central banks. We have to remember that they meet once a month. So it does allow, this smaller hike does allow greater flexibility based on incoming data and obviously then global economic financial conditions. But the bank policymakers, they did highlight how uncertainty over the economic outlook has increased. And they emphasized that the weakening global growth outlook was a key reason to slowing the pace of hikes back to 25 basis points. They're concerned about Australian households and how they'll respond to tighter financial conditions, although the assessment of the domestic outlook remains relatively upbeat, really. And there are then fears over a possible correction in the housing market. There are 2 bits of data actually before the next RBA meeting in November, employment figures on November 1st, and then the 3rd quarter inflation report later in the month. And potential surprises on those bits of data open the way for a 50 basis point hike in November. But it does seem as though 25 basis point increases are probably more likely from now on. But regarding that pivot, then the wider picture, if you like, does the RBA, does Australia have any relevance to the US? Well, the Australian economy is obviously much more open, much more traded than the US. And certainly weakness in China, for example, certainly weighs disproportionately on the Australian economy than it does certainly on the US. And then also Australia doesn't have as much inflation as other major economies, and so it probably can afford to keep slightly looser monetary policy than the other major economies. And while US consumer spending as well, that is holding together quite well. So just some observations really against that pivot, against associating the RBA move with other central banks, and certainly we've seen that in the RBNZ. Just on the Aussie dollar, the negative reaction after the RBA announcement was pretty short-lived, actually, in line with sort of this recent detachment, if you like, between monetary policy and FX dynamics, really. On the weekly, actually, we can see a break of that mid-July support at 66.81. That was really telling. And we hit 2-year lows as well, under 64, the low being 63.63. And we've sort of consolidated just above that level now, but we've sort of struggled to get above 65.38, really. So that is still key resistance. The repair is obviously quite vulnerable to the global risk mood, certainly, and also then with potential dollar strengthening. But certainly 63.63 is the key support level initially. Before that, probably around 64 if we do go lower. Just on the RBNZ, the Kiwi dollar, obviously they hiked by 50 basis points to 3.5% overnight, as widely expected. Actually, that was the 5th straight 50 basis point hike. The bank continues to see domestic core inflation pressures elevated, as the local economic outlook still remains modestly positive, despite those global recession fears. And while the statement itself was relatively hawkish and has been in the past few meetings, we do note recent comments by the Governor, Adrian Orr, which suggests actually that the hiking cycle is nearing its end and is very mature, I think he put it. He also mentioned, I think he has mentioned recently, getting rates to possibly 4% would buy some comfort for the bank. And also, actually, we note the weakness, obviously, in the Kiwi dollar kind of adds to the pace of inflation potentially going forward. So that's something to bear in mind if the Kiwi dollar stays pretty weak. Here's the chart, actually, so we can see Kiwi really being at the mercy of external forces. I think one investment bank put it that it's been drifting like a cork in the tide. And certainly you can see on the weekly again, we've sort of had several weeks of lower prices actually, and then that well, the low at 55.64, we can actually see then we're sort of towards these lows from the pandemic. Actually, that spike low in the March 2020, 54.69, and then 55.86. Obviously, we got down to 55.64, so just below one of those lows, and then we've bounced since then. On the daily, you can see, again, similar to the Aussie, really, just tracking sideways above those lows. Looks like bearish consolidation to us, really. We've struggled to get or close above sort of 57.60 area. You can see that pop higher this morning, actually, there. Yeah, towards 58, just above 58, 58.05, but then we've moved back into this potential sort of bearish consolidation, or at least consolidation for the time being. Resistance above, again, at the 21-day moving average, 58.60, and then obviously support around 56 for the Kiwi dollar. Right, let's finally wrap up with a look at non-farm payrolls. Key data point, as usual, for the dollar for markets. And certainly this is the last data piece, a jobs data piece, NFP, before the next Fed meeting on November the 2nd, I think it is. Payrolls consensus expectations for an increase, a moderate pace of 250,000. That compares to last month's or the prior figure of 315,000. Analyst forecasts ranging from plus 175 to plus 350. The jobless rate is projected to remain unchanged at 3.7%. Forecast range from 3.6 to 3.8, I think. And then average hourly earnings, probably a key figure, expected to have risen by 0.3 month on month and 5.1 year on year. And certainly the report will be digested to help gauge the Fed's reaction function, as we say, for the November meeting. The latest dot plots have signaled another 75 basis point hike in November. And markets currently assign around a 68% chance, I think it is, of that occurring. That did actually drop down to a near coin toss, around 54% actually at the start of the week, but then is pushed higher in over the last 24 hours actually. But it's probably expected, yeah, we do get this modest slowdown in employment. That probably won't be enough to deter the Fed from the still sort of front-loading aggressive rate hikes that markets are expecting, really. We'd probably have to get a headline print much lower, below 200,000, really, to get this pivot again to maybe a slower 50 basis point increment, and then back to sort of a 50, 54, 50 or 75 basis points. That would certainly put a brake on the dollar advances and then see more selling that we've seen obviously in the last couple of days anyway. Particular attention we kind of touched upon will probably be on the wages component and how it affects the inflation narrative, obviously after the hot CPI figures in the last weeks or so, and then the PCE figure as well last Friday. That September CPI print is actually next week, the 13th of October. Expectations for an 8.1% print there. So certainly if we get an annual figure on average hourly earnings below 5%, then potentially we find we'll get stocks being bought, and then also obviously that dollar going lower. Flip side, certainly if we get a solid report, that risks worsening the sell-off in bonds, the sell-off in equities, as the bets for a more aggressive Fed ramp up. A 75 basis point hike would then probably go above 70% chances of that, and that would obviously boost the greenback and knock this this pivot idea. We do have various Fed speakers obviously this week. As we've said, they're still fairly hawkish. Recent chatter has certainly been about keeping their foot to the pedal, if you like, but still there's a lot of focus on the Fed speakers as we go into the non-farm payroll. I think it's probably worth looking at, actually we have another chart here just showing you really the slowdown in growth. The bar charts here, the bars are the headline change, 250 expected, as I say, but you can just see that sort of general slowdown potentially as tighter financial conditions, rate hikes sort of slow up these job gains, and then you've got the unemployment rate sticking around 3.7%, 3.5% if you remember was I think around 50-year lows, so still relatively tight labour market. If we just look at finally euro dollar, actually just to sort of check where we are with that at the moment, as we go into sort of non-farm payrolls on Friday, we can see, yeah, euro dollar here, of course, the world's most popular currency pair, really. Blockbuster risk rally, really, it's followed that up, pressing into parity. I don't think we got there yesterday, just below there, actually, after this decent rally in euro dollar, rising close to 5 big figures, actually, in a little over a week. So a decent move in this, corresponding to that fall off obviously in the DXY. European assets, they've certainly bounced strongly, but it's kind of tough if you think about it, the broader picture, to see much change in that wider sort of Eurozone economic landscape, really. Recent data has highlighted that the slowdown in manufacturing is intensifying across the major Eurozone economies, and that's kind of underscores recession risk still amid rising energy prices, let's not forget, and also slower global demand. Euro dollar then, you can see we're sort of back around parity, key psychological level, and then the mid-July low at 99.52. Key levels here, 21-day moving average just above parity as well, but we've got the sort of long-term descending bear channel again highlighted there. Also that long-term trend line resistance, probably should extend this now, which comes in around parity, and the top of the bear channel around parity as well. So key level there, potentially if we do roll over, then we've got the the 21-day moving average is at 98.92, and then sort of nearer term September, 6th of September, that is the low there, around 63 as well. So potentially if we do roll down, there's near-term support there. Okay, we've covered a lot, we think. We hope you've enjoyed the webinar. We'll be back here, same time, same place, in a couple of weeks. But good luck trading out there. A lot is going on. It's very volatile still, we would say. And potentially if this pivot does roll over, then we see more dollar strength and stocks potentially turning south. Okay, take care, and we'll speak to you in a couple of weeks' time.